everyone. Welcome to the webinar today. So thrilled to have you with us. We have a very special guest and a slightly different format than we normally do. I am actually really excited for this one because we have Dwight Kay with us from Kay Properties and Investments, and he's going to be talking about his new book, which is actually the first book written on the topic of the 721 UPREIT strategy. And I really think this is a strategy that needs more education, especially for investors. So I'm so glad that we have Dwight with us. So before we get started, I just want to start with a few housekeeping items. As you all are coming in, if you want to say hello in the chat, I love seeing familiar names. I shouldn't say faces, but familiar names is always nice to see. Tell me where you're coming from. Tell me how long you've been a landlord or an investor for. I think that'd be fun for us to see in the chat. So put that in the chat, and then we're going to go through Q&A with Dwight here at the end. And so if you do have questions, we have a Q&A box. You'll see that next to the chat, so it's separate. So you can put your questions in there and we'll answer those in the order received. We are recording this webinar as well, so you're going to get the full thing tomorrow. Feel free to share it as much as you want with anyone you think this is relevant to. We'll also share any of the resources we'll go over today with you all. So before we jump in as well, I want to tell you a little bit about Dwight. For those of you who don't know who Dwight is, he's the founder and CEO of Kay Properties and Investments. It's one of the most experienced and knowledgeable investment firms in the country, specializing in Delaware statutory trusts and private equity real estate investments. And since its founding, Kay Properties has grown to over 4,000 clients and more than 50 billion with a B, of DST 1031 investments through the Kay Properties best-in-class platform. And most recently, as I mentioned, Dwight Kay authored the first book ever written on the increasingly popular 721 Exchange UPREIT strategy. So that's what we're going to be really focusing on today. And this is really, I think, going to help lots of investors here on the call. I also want to show you a quick little video snippet of Dwight at a recent conference talking to some investors as to exactly why this strategy is something you should be looking out for. So I'm going to go ahead and share my screen here real quick. And let me know if you can hear it okay. All right, let's get it.
Okay, 721 UPREIT offerings. That's what our next session is on. Due diligence is paramount. Just because a wealth manager says this is a great deal does not mean that you should plop your entire $1 million exchange into that one DST UPREIT. We see wealth managers putting clients, and we have thousands of clients nationwide. We've inherited a ton of clients from people that got into this with their wealth manager that didn't know what he was doing. And he put their entire $3 million exchange into one offering. It's really important that the 721, like I said, I've done 15 of them. It is a really great tool, but you do have to peel back the layers of the onion and understand the risk, understand what's going on, or else you might wake up one day and not be too happy, right? And so doing your due diligence on the 721, that's something we have teams of analysts at Kay Properties, not only on the 721 DSTs, but the entire menu of DSTs. Our teams are going through all the things I mentioned before, the appraisals, the underwriting, the assumptions, environmental, offering docs, looking at the 721 UPREITs, how they're structured, so that you can understand what makes sense for me and my family. And you might still like something, go, ooh, I don't like that, but I still want some exposure to that. But you're not putting your entire $5 million into that one offering that has a glaring risk factor. You might go, the likelihood of it happening is pretty low, but I do want to get 15% exposure there. That's what we walk you through at Kay Properties so that you don't over allocate. I mean, it's crazy. Wealth managers, if you have a $1 million stock portfolio, they put you in a broad-based portfolio of stocks. They don't go, this one company on the Fortune 500 is what you should put your $1 million in, or your $5 million, right? They diversify you. But then that same wealth manager gets his hands on your 1031 exchange, and he plops your entire $30 million into one DST UPREIT, one program. That's just not the way to invest when it comes to stocks as well as real estate. Okay, 721 UPREIT offerings. That's what our next session is on.
All right. So great to have you, Dwight. Love that you are speaking to so many investors about this topic and now coming to talk to our group about it. I'd love for you to share your screen if you do have some slides for us or something that we
Absolutely.
can see there. And I do see some friendly names in the chat. Ariel from Western Maryland. Junsha, yes, we will be sending any of the slides to you tomorrow. I do have those on file, so I'll put them in the follow-up email. Take a look at that. All right, Dwight, I'll let you take it from here.
All right. Thanks so much, Alexandra. Can you guys hear me okay? Everything good there?
Sounds great.
Perfect. Okay. So yeah, thanks again, Alexandra. Really appreciate it. It's been great partnering with you and the association over the years. And you know, just I think it is a timely topic, right? The 721 Exchange UPREIT. I'm going to kind of dig into it, kind of things to look out for, things to understand, things to ask about before investing. That's one of the ways that K Properties has grown to, as you said, over 4,000 investors nationwide have chosen us to help them understand 1031 Delaware Statutory Trust and 721 UPREIT investments. One of the reasons for us being, chosen by that many investors, nobody else has done that many transactions in this specialized niche than K Properties, but it's the education, right? Education has been critical. I mean, we've been doing this at K Properties for almost 20 years now. And I remember back in 2008, I wrote an article published, I think it was in the New England Real Estate Journal, just a small niche commercial real estate, newspaper out of the Northeast. And it was on the 721 Exchange UPREIT, right? So this is before anybody really had this on their radar, or most anybody had this on their radar. So the 721 Exchange has been something that has been around for a long time. Just like the 1031 exchange has been around for a long, long time, the 721 as well. But it wasn't really until, 3, 4 years ago that it started becoming a more, widely used vehicle for 1031 exchange investors, like investors on the line here. So, as we've been specializing in Delaware statutory trusts, 1031 exchanges, and 721 exchanges for almost 20 years now. We've had clients doing these things for a long time, but we saw a lot of the large institutions, the large REITs that were raising lots of money through the wirehouses, through the large financial services firms, the household names, raising a ton of money back in 2018, 19, 20, and 21 as property values were really at their peak, right? Because interest rates were very low at the time, and into 2022, and raising that capital from, cash investors, people where their financial advisor is giving them, allocating 50 grand to go into a REIT with a big household name. Buying properties, very low interest rate environment, very low cap rate environment. And all of a sudden, these large financial institutions have these multi-billion-dollar portfolios of properties that they bought at the peak of the market. Okay. And as interest rates started spiking in the second half of 2022 through 23, through 24, those portfolios started having problems. A lot of those REITs have short-term financing, right? Adjustable rate mortgages, ARMs, the revolving credit facilities, and their interest rates went from 2% up to 7% overnight, right? And so all of a sudden, not only did you buy as this big financial firm, this REIT, you bought at the top of the market billions, tens and tens of billions of dollars of properties, good properties. It's just the basis, right? It's what did you buy it for, right? And great properties, but at the end of the day, if you're buying at a very compressed cap rate, a very high price per unit or price per square foot, with short-term floating rate debt, and all of a sudden that debt jumps, you can get yourself into some trouble. So one of the things we do at K Properties is we track all these REITs, right? And look at the metrics. And that's what we're going to jump into today. But, I wrote the first book ever published on Delaware statutory trust investments for 1031 investors. That was, over 10 years ago. A lot of our clients had the same questions, and, they wanted answers. And we had been getting stuff published in various financial, publications, Kiplinger, Forbes, Yahoo Finance, real estate journals. We've been doing that for years. And so I decided, look, let me write this book on DSTs for 1031 investors to answer questions, right? And so that was the first one there. And then this past year, we published the 721 Exchange UPREITs, What Investors Need to Know Before Investing. And that's another first. There's never been a book written on 721 Exchange UPREITs, but it's something that's needed, right, to help investors dig in and to understand the risks. Because with real estate, with DSTs, with 721 UPREITs, there are risk factors. You can lose money investing in real estate and DSTs and in UPREITs. You can absolutely lose money. Property values can go up, property values go down. Tenants pay rent, tenants don't pay rent. And so understanding the risk factors is something that we highly encourage our investors to dig into prior to committing, right? So I'm going to just jump into it here. Again, 721 Exchange UPREITs. And I want to say the book here, we're going to go ahead and send you guys, if you request it, if just log on to kpi1031.com. That's our website. If you'd like a free copy of the 721 Exchange UPREIT book, we'll send it out to you. Or if you want a free copy of the Delaware Statutory Trust book, we'll send you that as well. So just log in at www.kpi1031.com and we'll send that to you. But we're going to dig into it. Again, these are complex tax codes, concepts, the 1031 Exchange, 721 Exchange. Talk to your CPA and attorney prior to making any decisions. We can't provide tax and legal advice, so please do speak to your CPA and attorney. These investments are only available to investors that have a net worth of over $1 million, excluding your primary residence, also known as an accredited investor. There's some different ways to qualify. If you have questions, if you do, you can reach out to us. We can talk to you about your situation. There's no guarantees in real estate investing. Like I said earlier, past performance is not indicative of future returns. Potential cash flows, returns, appreciation are not guaranteed, could be lower than anticipated. Before ever investing in a 721 UPREIT or a Delaware Statutory Trust, you'll be provided a private placement memorandum. PPM is what it's called, what the acronym is. And that goes through the business plan of that property or that UPREIT and the risk factors. Okay, so we'll provide you with that. Make sure to read it, ask questions. Don't invest if you're not comfortable with the risks involved with investing in real estate and these types of investments. So quick overview here. This is the Kay Properties team. We've been doing this for almost 20 years now. We've helped over 4,000 clients nationwide purchase over 10,000 different Delaware Statutory Trust, 1031 Exchange, and 721 UPREIT investments. Our platform provides access. This is kind of something that's a little different than us, than others. Many people that sell these types of things, they're financial planners. They don't know anything about real estate, but they do have access to selling 1 or 2 DSTs or 721 UPREITs to their investors. The problem is they don't have any specialization, and we see them over-concentrate investors. The whole purpose of the DST 721 UPREIT vehicle is to provide diversification for investors. It doesn't guarantee profits or protection against losses, but it is something that we believe is a prudent way to be investing in real estate. We actually just had somebody reach out to us today who has a $3 million 1031 exchange. Her financial advisor advised her to put her whole $3 million into a 721 UPREIT, which we've done the diligence on that REIT. We know that it's got some glaring problems. There's some red flags there. There's a lot of short-term debt that's coming due. There's a lot of properties that were purchased at way overvalued prices. And so it just, again, goes to show just because somebody can offer this stuff does not mean they're a specialist, does not mean that you should go all in into any one offering, right? The beauty about K Properties is that we work with over 25 different sponsor companies, okay? These are the DST companies that put together DSTs for 1031 investors, as well as the REIT companies that have the 721 UPREITs. On our marketplace, these REIT and DST sponsors, they post their offerings on our marketplace at kpi1031.com. So our investors get to log in, they get to view all the offerings from all these different sponsors on the market and not just see 1 or 2 that their financial advisor has, but they get to see the entire market. It's kind of like you as a real estate investor. You wouldn't want to have your you're a real estate agent, say, these are the only two properties in Chicago or two properties in Miami that make any sense. You'd want to see everything so you could get an idea of what's going on in the market, right? That's kind of what we're doing at the K Properties Marketplace. You get to see all the different offerings, all the different sponsors, compare and contrast them. We also have our full due diligence reports available for our investors to see what we've done as we've gone into the appraisals, property condition reports, environmental reports, the zoning reports, the leases, as well as on the 721 UPREITs, we analyze the final destination REIT, okay? You might be exchanging into a Delaware statutory trust that has an industrial property with a large tenant, and you like the property, you like how it looks. But what most financial advisors do is they don't even look at the destination REIT, where that property is going to end up in 2 years. And that's something that we do. We dig into the Qs and Ks, the public filings of these publicly registered non-traded REITs. We dig in and do the heavy lifting, and we provide that for our investors. So there I am again. So this was and the clip that you saw was at K Investor Day. It was last year, I believe in March. And we had almost 200 investors nationwide from 11 different states come out to it. If you're seriously interested in a 1031 exchange, Delaware Statutory Trust, 721 UPREIT, please do register at our website because K Investor Day is coming up again shortly. April 16th, it's going to be in Newport Beach at the Balboa Bay Club. We're expecting 250 to 300 investors from all over the country coming in. And what we do there is we bring some of these top sponsor companies and the founders or the main principals or of the REITs, the 721 UPREITs. And we have panels, we have education, we have diligence discussions to further educate our investors. So if that's interesting to you, we'd love to have you out there. But this is, again, K Investor Day. I don't know if you can see there, but I've personally been investing in DSTs since 2008 was the first one that I bought into. And I've got over 50 of them that I've personally done with multiple different sponsors. Again, that's what you're getting with K Properties. We've worked with over 4,000 investors. I've invested with many of the sponsors that you would be considering in an exchange. We really know this space, and that access to information and insight is critical for our investors. Quick story. We had a client yesterday who reached out, and there is a sponsor that has a deal out there that looks okay. I think it has some risks that aren't really warranted, and it's not really a risk-adjusted deal. But I'm like, I've never heard of this company's name before, and this is all we do, right? And constantly sponsors are bringing deals to us, trying to get onto our platform. We diligence them. We reject a lot of them. But that sponsor, I'd never heard of them before. And so I started doing a little research, and it turns out this sponsor was a rebrand. And that's something common when a group puts out a deal and it fails, right? They'll change their name, right? They'll change their name. And so this sponsor was a rebrand, the same exact company that they pitched us on their deals. We passed on them 15 years ago, over and over and over. A lot of clients invested with them through others. And we said, we don't like it. We don't like this tenant. We don't like what's going on here. And we passed on it. That's fine. We missed a lot of business, but we told people the potential risks because that's what we do. And lo and behold, the company lost tens of millions of dollars for investors. They were litigated to kingdom come, okay? Huge amounts of litigation. Really just a massive, massive problem for those investors. And they wished, and we've had many of them come back and say, I should have listened to you. I invested in this deal. Well, anyways, fast forward, here we are. That same company changed their name. And now they're doing the exact same thing with a sketchy deal, a sketchy tenant. That's the insight that our investors are getting. So we were able to share that with our investor. That's what we're trying to do. So why did I write this book? Again, K Properties, we believe education is the bedrock of intelligent investing. It builds confidence. It enables informed decisions. We saw a huge gap in investor education when it came to 721 Exchange UPREITs and realized that investors needed to understand the intricacies and potential pitfalls of investing in these. We also saw, excuse me, just going to move this here. We also saw there's just this massive lack of knowledge perpetuated by the financial advisors, a lot of big name firms just selling stuff that,
once you dig in, it would be very hard to convince anybody to really want to participate in these deals. And so we just wanted to provide that knowledge base to investors, foundational concepts for advanced due diligence, and it's really necessary before committing capital. Okay, so look at the chapters. I'm gonna go through each one very quickly, but chapter 1, what is the 721 UPREIT exchange? Number 2, due diligence on 721 exchange UPREITs. Number 3, the REIT's option but not the obligation to exercise the 721 exchange UPREIT. Number 4, the pitfalls of perpetual non-listed REITs. Those are the 721 UPREIT sponsor companies paying dividends, right, to investors from borrowings, from loans from banks and DRIP programs, dividend reinvestment programs. Number 5, the importance of fully covering REIT dividends from adjusted funds from operations, AFFO. Chapter 6, why optionality matters to investors. Very, very important. I've personally done over 15 721 exchange UPREITs myself for my family. And every single time, because when I invested in that DST, I knew there would be an option. Okay. I was able to analyze the REIT at the time of the 721 exchange. And I was able to choose, yes, I like the REIT. I like the metrics. I want to go into this, right? Where many of the 721 UPREITs in today's market, they're forced. So if you go into the DST today, in 2 years, you're forced to go into the REIT, the final destination REIT. And the problem is, what if the REIT is deteriorated financially? What if the REIT's management team is totally style drifted, right? I want myself and my investors to have options and not be forced to do anything. Chapter 7, one-way street of 721 UPREITs, no more 1031 exchange tax deferral. Chapter 8, understanding 721 UPREIT risks and the crucial role of tax protection agreements. So very quickly, chapter 1, we dig into what is the 721 exchange UPREIT. So for DST investors, the Umbrella Partnership Real Estate Investment Trust, or UPREIT, is a potential exit strategy. In an UPREIT transaction, investors exchange their DST shares for OP units or operating partnership units in a real estate investment trust. The investor then becomes a limited partner in the REIT, deferring their capital gains taxes on their 721 exchange UPREIT transaction. So here's how it works. You sell your 15-unit apartment building in Chicago or Miami or LA, or your farmland in Iowa, or your self-storage facility in North Carolina, whatever it is you're selling, your investment or business purpose, real estate, like-kind real estate for a 1031 exchange. You sell that property, you 1031 exchange into a Delaware statutory trust, right? Which is a trust, just like a family living trust, but it's a trust that holds title to something like an apartment building, 300 units, or an industrial distribution facility, 100,000 square feet, or a self-storage facility. The DST, then, you now 1031 exchange into the DST. In a couple years, that DST will be contributed into a REIT. And instead of DST shares, you'll swap for REIT shares or operating partnership units. That's the 721 exchange, and that's a tax-deferred moment, okay? So again, we're going to get into the critical things that you have to look at before investing in a DST that's talking about a 721 exchange potential exit strategy, critical things to consider. So essentially, you sell your property that you own and manage, you exchange 1031 into a DST. A couple of years later, that DST is contributed to the operating partnership of the REIT, okay? Now you're in the REIT. Chapter 2, 721 UPREIT due diligence. It all sounds great, potential liquidity, diversification in the REITs, big management team. But what are some of the things that you need to look at as an investor in terms of due diligence to make sure you're not jumping into a situation that you're going to regret later? So it's important to note due diligence does not guarantee favorable outcomes, okay? You can diligence a property. You and I could go look at a 100-unit apartment building that we're going to buy together. We could diligence its death, but the property could not perform, right? There's no guarantee that due diligence is going to provide a favorable outcome. There's risk. You could lose money investing in properties on your own, DSTs, 721 UPREITs. Due diligence does not remove risk, but it's a prudent thing to do, in our opinion. So we review scores of new 721 UPREIT offerings, and we take our due diligence process very seriously. Some of the items that we potentially utilize in our due diligence process may include the following. Excuse me. One, sponsor company and track record review, background checks, track record review, REIT liquidity assessment, debt considerations, very important. And we dig into this in the book. So if you want more details on these, the book is going to be a great resource for you. Number two, rigorous asset and offering analysis, the lease review, tenant creditworthiness, long-term trends, lease provisions and risks, development in the area, absorption in the area, occupancy trends, leasing trends, etc. Number three, your property condition reports. We're looking for deferred maintenance. We're looking at capital reserves that are potentially necessary over a 10-year term. The building systems evaluation. How's the roof? How's the parking lot? How's the AC? Looking at the zoning report for compliance, looking at environmental reports. The phase one, the phase two, if there is one, previous land use, zoning compliance, a lot of different stuff that we're looking at, and we have a sister company that actually is a sponsor, right? Kay Properties, we work with 25 different sponsors. We show you the entire marketplace. We also have a sister company called Cove Capital Investments that goes out and buys properties. We've bought over 130 or so properties in 37 states over the last, 8 years or so. And, we do all this as a sponsor, but as K Properties, we're taking all that information from each one of the sponsors and we're diligencing it, looking at it, understanding it, providing a report, and helping our investors understand what the potential risks are of investing in the property. We're looking at third-party market reports, market trends, demographic insights, competition analysis, tenant performance, supply and demand. We're looking at, this is very important here, arm's length or affiliated transaction scrutiny. Okay, what I prefer when I'm investing in a DST is that the seller of the DST property is a completely separate company and not affiliated with the DST sponsor or the REIT sponsor, right? Because what happens, and we see this all the time, DST and REIT sponsors, they'll take a property and they'll buy it, and then 2 months later they sell it to the new DST investors at a 10% or 15% or 20% markup. And the value of the property hasn't gone up by 20%, but the new investors are. So that's something we have a critical eye on, and it's very, very important. I always prefer that it's a non-arm's length, that it's an arm's length transaction, okay? That it is a non-affiliated seller, and it compares the initial purchase price of the property to the price at which the property is being sold to new investors. A lot of the REITs, what we saw, 2022, they bought at the peak of the market, very compressed cap rates. And all of a sudden in 23 and 24, they're selling that same property that might have actually gone down. It definitely went down in value because interest rates went up by 200 basis points. The lease term on the industrial property went down by 3 years. And with net leases, as you know, the primary term burns off and you lose value. You have cap rate expansion there. And all of a sudden that REIT is selling that same property to the new DST investors at a 20% markup. But yet they're telling investors, oh, we have the lowest fees in the business. Yet they have a 20% markup that's disclosed in the PPM, right? They share that with investors, but it's very hard to find. That's what our analyst team at K Properties is doing to help walk our investors through this stuff. So number 7, understanding valuation and markups, reviewing the fine print in the PPMs, reviewing the REIT's debt profile, examine dividend coverage and true yield, net inflows and capital improvements. Caveat emptor, it's a Latin term for buyer beware. We have seen many so-called experts in this space, financial advisors, planners, recommending investing a client's entire 1031 proceeds. And sometimes this is up to $5, $10, $20, $50 million into a single 721 UPREIT without examining these critical indicators. That doesn't sound like very good due diligence or financial planning to me. Again, a financial advisor would never have you put $10 million into, even Apple stock or Microsoft or one of the world's largest companies. It wouldn't be prudent, but then they'll put you into a 721 UPREIT that is basically a penny stock compared to some of those bigger companies, and they'll over allocate you in it. That's the stuff that we're looking out for our investors, to protect our investors. Chapter 3, the REIT's option, not the obligation, to exercise a 721 UPREIT. This is all about how the REIT is not obligated to acquire the property in a 721 exchange from the DST investor. So it's really crucial for investors with an UPREIT exit strategy to examine thoroughly the final destination REIT. Make sure that final destination REIT, where your DST property is going to go, aligns with your risk tolerances. As we go through these numbers with many investors, they opt to not do the 721 exchange UPREIT because they don't like how the REITs look. They like the DSTs because they're standalone offerings, and it's a much clearer picture of what's going on. So given the complexities of the 721 UPREIT exchange, investors have to exercise extreme caution and assess both the acquisition price and the subsequent markups they're passing along to DST investors. Chapter 4 is all about the pitfalls of perpetual life non-listed REITs paying dividends from borrowings. So this is something that's really concerning, in my opinion. And one of the reasons why many of our investors at Kay Properties, they choose to go with a 721 or into a DST that only has an optional 721 exchange exit strategy. They don't want to be forced because they want to look at this metric. Is the REIT paying out of borrowings and new investor money, or are they generating the cash flow for the dividend out of the actual properties, the rents minus expenses, is the NOI minus debt service, the free cash flow, is that supporting the dividend to the investors? Or is it, kind of a smoke and mirror situation where there's a dividend, it might look good, but it's being paid out of debt or new investors? So perpetual life non-listed REITs have gained popularity among investors, unlike publicly traded REITs. These non-listed REITs do not trade on public exchanges, and they can contain significant risks associated with how some of these perpetual life REITs fund their dividends. So dividend reinvestment programs, or DRIPs, an illusion of stability. Borrowing funds to pay dividends can create an illusion of stability. It can create a higher potential dividend. Using borrowings to pay dividends basically means the REIT is taking on additional debt to fulfill its dividend obligations. This can create a vicious cycle where the REIT has to take on even more debt just to service existing debt to continue paying dividends. The DRIP programs, dividend reinvestment programs, can dilute shareholder equity as the REIT is increasing its share count without an increase in underlying assets. And these DRIPs can mask underlying cash flow issues. So we look at these, we analyze the numbers because it's all publicly registered, non-traded, these 721 UPREIT programs. So we can pull their Qs and Ks, right? And some are better than others, right? Some look, relatively healthy. Others, there's some glaring issues. And so we look at that and we look at, okay, well, their stated dividend is, 4.5%. How much of that is actually coming from the properties, right? And a lot of times we'll look and we'll see it's only, 1.5 to 2.5% of the 4.5 coming from the actual properties. That's a red flag. That's something our investors need to be aware of before deciding to pursue any type of strategy like that. One of the metrics we look at is adjusted funds from operations, or AFFO. It's a critical metric for assessing a REIT's ability to generate cash flow from its core operations. So AFFO, it's a clear picture of the REIT's cash flow available for distribution. REITs that fail to cover their dividends with AFFO are demonstrating a red flag that dividends are not being generated from core business operations, such as the properties and rents from the tenants. REITs that continue to pay dividends in excess of their AFFO can deplete capital reserves, erode shareholder equity, and increase financial risk as they're increasing their borrowings. And this practice can lead to a downward spiral where the REIT is forced to cut dividends, sell assets at inopportune times, or take on even more debt, further exacerbating its financial instability. So looking at those numbers is something our diligence team, our REIT team here, does very consistently for our investors. We want to know, how is this REIT, what's the health of the REIT or the lack thereof? Chapter 5, again, it's the importance of fully covering REIT dividends from AFFO. One key measure of a REIT sustainability is whether, again, dividends are fully covered by AFFO. AFFO is widely regarded as the most accurate measure of a REIT's operational performance. AFFO adjusts for capital expenditures and maintenance costs. When a REIT's dividends are fully covered by AFFO, it reflects an operational efficiency. It's what you want to have. In contrast, when a REIT struggles to cover its dividends from AFFO, it may be facing challenges as rising interest rates. That a lot of these REITs have short-term debt, right? Adjustable rate mortgages with variable rate interest rates on those loans. So as rates were rising, they really got hit hard. They looked like geniuses when rates were, incredibly low, because you're making money hand over fist as the REIT, but all of a sudden that turned on them. Okay. High maintenance costs, poor property management, or inability to generate sufficient rental income. A lot of our investors are looking at the distributions from the DSTs, the dividends from the UPREITs, as a way to supplement potential income, their monthly income. And so it's really incumbent upon us to look at these numbers and not just encourage an investor, oh, look at this company. You've heard their name in the Wall Street Journal. They're a great company and they've got billions of dollars and they're huge. That doesn't matter. What matters is the actual investment that the client's making. What's the health of that? That's what we want to look at. This is a little bit, I know we are short on time, so I'm going to bump past that. But Chapter 6, why full optionality matters for 721 UPREIT DST investors. This is very important. With both Delaware Statutory Trusts and 721 UPREITs, retaining full optionality is paramount for investors. You as investors need flexibility for both the entry point and the long-term exit strategy. You don't want to be forced into doing anything that you don't have to. Typically, investors prefer that firms provide full optionality. It's definitely a trend in the industry. I think we've had a hand in that as well at Kay Properties, as we've done many times in other areas of the industry where we've pushed to make things we believe are better for ourselves as investors as well as our investors. Many of the 721 UPREITs are forced UPREITs. We're starting to see some of the big ones switch to fully optional because investors are starting to understand they don't want to be forced. If the REIT is deteriorated, I don't want to go into that REIT. I want to be able to be in the DST. They could pull the property in the REIT, but I want to get cashed out and do another 1031 into another property I own or another DST. I'm not going to jump onto that potentially sinking ship. And so full optionality is very important. It allows investors to choose their path based on their financial goals, tax planning, and personal circumstances. So the problem with forced 721 UPREITs is you have a loss of control. Investors no longer have discretion over their exit strategy, and you have a lack of reliable liquidity. Many UPREITs, well, let me back up. A lot of investors look to the 721 UPREIT as, ooh, I like this because I'll be part of a REIT and I can get liquidity. Maybe. The problem is that, and they all have a liquidity feature, right? That the 721 UPREIT sponsor has in place. That's nice. But if you read the fine print, it can be gated, oftentimes 5% of the outstanding shares per quarter or per year. And so they can gate liquidity at the discretion of the sponsor at any time. And so investors went into the 721 UPREIT thinking they were going to get liquidity. And then at the second they needed it most, it's gated. And we've seen this with many of the large REIT sponsors. They've gated liquidity and there's been a run on the REIT, and you can't blame them. The REITs can't just sell all the properties in a bad market or in a time of distress, but it's really important that understanding these are not liquid. They can be gated. So many UPREIT sponsors have gated liquidity when investors needed it most. So the reliable liquidity with the 721 UPREITs, it doesn't exist. I would say don't invest in a 721 UPREIT if you're looking for liquidity. In my opinion, if you're selling a building for $1 million and you want potential liquidity down the line, you should talk to your CPA and attorney right now and peel off a portion of that capital, pay your tax on it, and get liquid now. Don't exchange your full $1 million into the DST that's going to be in the 721 UPREIT that you might need liquidity in a couple of years and you can't get it back. right? So I think liquidity really is best found upon the exit of your original property. Talk to your CPA, talk to your attorney, understand your tax hit, and get liquid then, right? That's my opinion. Um, so chapter 7 is all about the one-way street of 721 UPREITs. No more 1031 exchange tax deferral. So unlike a 1031 exchange, which allows investors to reinvest in like-kind properties indefinitely, a 721 exchange means giving up the ability to further defer taxes via 1031 exchanges. And this is why full optionality is so important. So a hypothetical example here, a case study of why doing a forced 721 or of why avoiding a forced 721 is so important. The original DST, investor invests in the DST, which holds a large industrial property leased to a Fortune 500 company. 721 UPREIT transaction. 2 years later, the REIT initiates the 721 exchange transaction. REIT reevaluation. Investor discovers that the REIT is not covering dividend from adjusted funds from operations, has exposure to floating rate debt, and has invested in numerous hotel developments, right? And that's the style drift. You could have a REIT today that does apartments and industrial buildings, and then all of a sudden there was some shakeup at the institutional level, and they shifted strategies to higher potential return investments like development or hotels or senior care properties, which are higher risk. That's why they trade at higher cap rates if you go out to buy one of those. It could be a complete style drift and you might not be comfortable with it, but you have no way out. The investor went into a forced 721. They didn't have a financial planner or a group, an advisor that actually looked, is this forced or is it optional, right? They didn't have somebody like Kay Properties sharing with them these potential pitfalls. So they went into the forced 721. All of a sudden, there's no way out. The investor would prefer to 1031 exchange into another DST, but because that original DST that he went into had a 47121 exchange structure, that choice is no longer available to the investor. Chapter 8, another very important thing when considering DSTs that have a 721 UPREIT exit potential strategy. Tax protection agreements. The financial planner, the financial advisor, they don't specialize in this. They don't know anything about this, right? The tax protection agreement is a crucial aspect and a hidden risk of 721 UPREITs. Okay, so this is, just bear with me here. Contributing a DST interest into a REIT via 721 UPREIT defers capital gains taxes. However, certain events can trigger taxes later on. One of these is if the REIT sells the contributed property or DST for cash, causing the original gain to be recognized. In this case, the investor receives an unexpected tax bill. Some REITs mitigate this with tax protection agreements, or TPAs as we call them, which prohibits the sale of any contributed property for a period of time or requires the REIT to compensate the contributor if a sale triggers their deferred tax. So what that means is you could be in a DST that does the 721 UPREIT, and then 2, 3, 4 years later, the REIT could decide, you know, we don't like this property, let's sell this property. They all buy and sell properties all the time. If your original DST and 721 UPREIT did not have a tax protection agreement, if they sell that property and don't do an internal 1031 exchange as a REIT, all of a sudden all your gain is due and payable as tax, right? Even though you're diversified amongst the REIT and you're not in that one property anymore, all of a sudden your tax bill is due. And we've talked to investors that this has happened to them. There's case studies in the book where this has happened. Most of the 721 UPREITs that are out there specifically say in their prospectus, in the fine print, we will not offer you a tax protection agreement. Okay. Why do they say that in the fine print? Because they might do it and they don't want to have to be on the hook for paying your taxes. Okay. For an investor putting 10 or 15 million bucks or, you know, even 150 grand into this and not being ready to pay that tax, thinking they're fully deferred and this happening, it could be devastating. So the tax protection agreement, most of the 721 UPREITs out there, if you read the fine print, they say, we are not offering you one. Others say, we're giving you one for 2 years or for 5 years. It's hardly enough time, right? It's hardly enough time. A lot of investors considering these are 50, 60, 70 years old, right? And 5 years goes by fast. If they sell the asset, you could be hit with a massive tax bill that you weren't planning on, and that the people that sold you this thing didn't talk to you about this. On the other hand, there are certain sponsors that in their 721 exchange exit potentials, they specifically state, we will offer you a 20-year tax protection agreement. Okay, that's the gold standard. That's the highest we've seen in this space, a 20-year tax protection agreement. And that's very, very important for investors that are considering this strategy. Be very careful there. So any investor who is considering placing a significant amount of their net worth into a single 721 UPREIT DST program without a tax protection agreement, or one that's very short in nature, 2 to 5 years, that's hardly enough time at all, should take a hard, long moment to consider the potential tax consequences of what that would be. And remember, your money's still tied up in the REIT and illiquid potentially. And then all of a sudden your tax bill comes due, it could be really bad. So tax protection agreements, a crucial aspect and hidden risk of 721s. Alarmingly, most financial advisors, RIAs, and wealth managers remain unaware of tax protection agreements. At Kay Properties, we have a number of financial planners and RIAs that they contract with us. When they have a client in a 1031 exchange, they realize they're not the expert at it, and they have an agreement with us where we help their clients through that process, right? Because we're specialists. Many RAs and financial planners, they do these, they put their clients into these deals and they have no idea what's going on. It's really scary, right? And this is where this book and the diligence that you should be doing as an investor is very, very important. These same professionals often guide investors to deploy significant 1031 exchange proceeds into DSTs with mandatory, aka forced, 721 UPREIT provisions without any tax protection agreement. Also, if such protections do exist, as I stated earlier, they only cover sometimes 2 to 5 years, leaving investors dangerously exposed to future potential tax consequences. So this is funny. Our marketing team threw this in there. You want to be this guy here and his wife asking the advisor, is there a tax protection agreement in place? They're not going to know what that is. They're going to go, oh, we have to go talk to, let me go talk to the REIT. We'll find out for you. And it's probably not in place, or it's only 2 to 5 years. So make sure to ask that question. You need to ask it prior to participating in a 721 UPREIT DST. Documented cases and commentary make one thing clear. If a REIT sells a contributed property and no tax indemnification is in place, the original contributor will likely face an unexpected tax bill. You've got to carefully review tax protection agreements if they're there. If they are there, what's the terms and duration? Very, very important. We've got some case studies in the book that are going to go through that. Some very large names, Archstone, Tishman Speyer. You've got who else? Empire State Realty Trust. These are documented. There's been litigation about this where tax protection agreements, started going awry for investors. So we've got that in the book. Again, we'll send you a copy of the book, and that pretty much wraps up the PowerPoint. This is a quick overview of what we can get you. Register at www.kpi1031.com. We'll get you free access to our marketplace for accredited investors of DSTs and 721 UPREITs. Again, from over 25 different sponsor companies. So you're going to be able to see many different offerings and properties available. Sorry, I got a pop up here. So register, we'll get you set up with a password. We'll get you a listing menu of numerous strategies. We've got debt-free DSTs. We've got leveraged DSTs. We've got zero coupon DSTs. We've got 721 UPREITs. We have UPREITs that have optional participation. We've got the mandatory participation if somebody has to have that. We don't necessarily recommend it. But we typically have 20 to 40 different DST offerings available. All different asset classes, all different sponsors, multifamily, industrial, retail, net lease, medical, et cetera, et cetera. So you're going to get to see the breadth of the market to consider what makes sense for your 1031 exchange and your family. We'll get you a book, the original book on DSTs. We'll get you a copy of that, which has a chapter on 721 Exchange UPREITs as well, from when that was written over 10 years ago. And then also we'll get you a subscription to our DST Digest magazine, case studies, articles, etc. All things 1031, 721 DST. And then we'll also get you a copy of the subject of our webinar today, the 721 UPREITs, key things for investors to consider. Again, the first ever book written on the subject matter. So let's see. We're here to assist you anyway. Feel free, register, call us, email. We're here to help you out. So we thank you guys so much. We really appreciate your time. I'll turn it back to Alexandra.
Yeah, thank you so much for that. I did put up that poll question. If you saw that pop up, it's easier to just say yes to that. Then afterwards, the K Properties team will reach out to you with those resources. So I'll leave that up for a little longer and we can dive into questions. So please put your questions in that Q&A box so we can go through them. We have a few already. Gary is asking, what is the minimum value of property to meet the requirements for the 1031 to 731 exchange via K Properties?
Sure. So great question, Gary. Thanks for that. Typically, I mean, we have many clients that have done 10, 20, 50, $100 million exchanges with us into DSTs, into 721 UPREITs. But a large amount of our clients are investing anywhere from 100 grand up to, $2, $3, $4 million. That's a huge subset of our client base. But with that, we've had clients that, they're buying, small lots in the Carolinas over the years and selling one for 12,000, one for 15, one for 20. We can help investors. We want to help investors. So really minimum investments in an offering is typically 25 grand, 50 grand, or 100 grand, depending on the sponsor. Because of the volume, we're handling, 10, 15, 20 different exchanges per week. And deploying that capital in the DSTs and 721s, we can get minimums waived by sponsors for you. So we'd love to help you if we can. Obviously, everybody has to qualify to be able to invest in these, but yeah, minimums aren't really a factor for us. We just, our thing is helping investors exchange and defer taxes.
Great. Well, that's good news. Okay, question from James. What is your fee structure? How do you get compensated for assisting clients? He has a couple more questions, but I'll start with those two first.
Yeah, great question. So fee structures are different across the board for DSTs and 721 UPREITs. Each offering is different, and we dig into the fee structures in the private placement memorandum, the PPM. It's all fully disclosed, okay? All the fee structures are fully disclosed. We end up getting paid for advising our clients. It's similar to a real estate commission, okay? So again, some are higher, some are lower. We walk you through those. The way that we've decided to set up the business, because these can be typically a 5 to 10 year hold period, okay? My first DST that I went in was over 12 years, right? Some RIAs say, oh, and financial planners, we're better than a commission, right? We're better than K Properties because we only charge 1% a year. Well, until the property is held for 5, 6, 7, 8, 9, 10 years, 12 years, and you just pay double than working with us. So we have the ability to do just an annual fee. The problem is these are long-term buy and hold strategies. So investors would potentially be paying much more going that route. And that's, again, a nuance that if you don't do these things, that might sound better, right? But and so I would say that they're all the fees are different. We'll walk you through them. They're all fully disclosed. I would also say this. I have seen over my years people touting their excellence in this space and, oh, I looked at this one has the lowest fee structure, and I look at the property and yeah, it has the lowest fee structure, but it's got the highest risk potential because it's highly levered and it's an exotic asset class like a hotel or a senior care deal. And then the other one, the contrary one that the client was looking at was a lower potential risk, like an apartment building or a net lease with a large Fortune 500 tenant, maybe had a higher fee structure. But guess what happened in 2009, 10, 11, and 12? The ones with the lower fee structures, with the higher debt that were hotels, they were all foreclosed on. Investors were completely wiped out. My clients that went into the ones that had a little bit higher fees, like literally a minuscule higher amount of fees, ended up doing very well on those properties, and they could hold through the recession. They could stand the test of time. So yes, fee structure is something we look at and our analysts are critically evaluating. But I really, when I'm investing personally, I'm not just going, oh, I want the lowest one, because that might not be a piece of real estate that I like or feel comfortable with.
Thank you, Dwight. That's an important distinction. Well put. James also was asking, what is a good projected IRR for a 721 exchange or REIT? Do you have a hurdle number?
Yeah, I mean, potential returns, it's really tough. I mean, we've seen them across the board, right? We've seen some do very well. We've seen some of these REITs not do well at all. And so the IRR, it's a projection of how is this thing going to perform over time, right? And unfortunately, IRRs are always wrong because nobody knows what's going to happen over time, right? What's going to happen with interest rates? What's going to happen with cap rates? What I would say is that when you reach out to us, we'll walk you through each one of the sponsors' track records, and that shows what they bought before, how it performed on a cash flow basis, how it performed on the sale basis for the investors, net of fees and costs. Okay. Track record, something I really want to look at carefully for each one of the sponsors that I'm personally investing in or our clients are investing in. And the reason being is that, first off, past performance does not guarantee future results. The track record could look stellar and the sponsor could still lose money, right? But it is something that I like to consider because, and it's really based on the fee section, right? Like the question on fees. I want to look at track record because that's net of fees to investors. How did they do, right? And when you reach out to us, James, we're going to dig into each one of those groups. There's over 25 of them, and we can walk you through what they've done in the past. Again, with the caveat, there's no guarantee for the future.
Okay. Dwight, can you stay a few minutes over here at the hour mark? Wonderful.
Sure.
Okay, so Steve asked, can the REIT at some point sell the asset without triggering a tax liability to the original 1031 property contributor?
Only if the REIT sells the property and does their own internal 1031 exchange.
Okay,
Okay.
interesting. Also,
And
he
so it's
asked,
basically just it's
Mhm.
opening yourself up to risk of, well, what if the REIT, the reason why they're selling assets is because they've got other debt in the portfolio coming due, right? All that
Mhm.
CMBS debt from 15, 16, 17, 18, it's all coming due right now, right? And so you've got assets that need to have their loans paid off, and you can't 1031 exchange into a loan. It's not like kind property. So they may sell that asset. If they do an internal 1031 exchange, great. You're protected, the taxes are deferred. If they need that asset's proceeds to pay off debt to not be foreclosed on another deal, you could be out of luck. And again, it's not that it's going to happen, it's that we want to look ahead at what situations could affect our investors, right? This is very, very important. So
Hmm.
it's something that we like to consider for our investors.
Great. Also, he asked, wouldn't a 20-year tax protection agreement still be problematic?
I mean, I think it's a lot better than no tax protection agreement. I think it's a lot better than 2 years. I think it's a lot better than 5 years. If you're not comfortable with a 20-year tax protection agreement, don't do a 721 UPREIT because that's the best that there is right now that a sponsor has considered. And the 20 years for most investors doing a 721 UPREIT, likely in 20 years, they'll have passed and their kids will get a full step up in basis, right? Talk to your CPA and attorney about that, for your own tax and legal advice. But that's the whole thinking where 2 years, 5 years, it's nothing, right? So,
Yeah. Yeah, makes sense. Someone asked about the recording. So yes, we will be emailing everyone the recording, the slides, the resources, everything. So keep an eye out on that. Also asking here, where is your home office located? You're in rainy Southern California
I
today.
know, I know. It's
Me
raining. I
too.
got rain. Oh, okay. I was rained on today, all morning long. But we're in Torrance, California. So Los Angeles, we're about 20 minutes from LAX. We have clients come visit us. This is our corporate headquarters. We have some smaller offices throughout the country, but this is our main corporate headquarters with our legal team, our CFO, all the staff, all the support, transactions, et cetera. But we have clients come in and visit us all the time. So if you're local in Southern California, or if thinking about a large exchange, we encourage you come out, visit us, meet with us, talk with us. Also, it's a perfect time because again, we have K Investor Day coming up April 16th in Newport Beach, and so you come see us, tour the headquarters, and then come for that educational event too.
Well, you answered the next question. When is your
Oh,
event?
yeah.
April
So
16th. We'll put some info in maybe the follow-up email
okay,
for that as well. If you have
yeah,
anything, you guys can mark your calendars now. I would also love to go.
yes, please.
Yeah.
Be great
So
to meet
that's
you in person.
exciting. Yeah.
Yeah,
Wonderful.
absolutely. So April 16th, Alexandra, if you reach out to Vincent, he can get you something that you can send out with all the details.
Great.
But we also do symposiums all year long for our investors where we'll have, 20, 30, 40, 50 investors. We'll do a dinner, kind of a mini K investor day, and we do them in Dallas and Miami. We do them in Washington, D.C., Virginia, New York City, San Francisco. So pretty much all over the country. So we'd also love to, have folks come out to those. We did one in Chicago recently.
Oh,
So
nice. Wonderful. Okay. So a few more questions. Amir is asking, once you are in the 721 UPREIT without tax protection program, are you paid by the REIT when you end up owing capital gains taxes or your original investment is moved into another property?
well, without the protection agreement, there's no tax protection.
Yeah.
So hopefully, if you're already in that 721 UPREIT without one, or it's past the 2 to 5 years, hopefully they don't sell the property that you contributed, because then you will have, a tax bill. Now,
Mm.
again, if the REIT sells your property and does an internal 1031 exchange, your taxes are deferred, right? But if you don't have the agreement, you don't have it.
Depends on them. Yeah. Well, Ming also asking here with a 1031 exchange, will the promised return rate, say 5%, be dropped within the exchanged period?
So I think the most important thing to do is go that there's no promise for returns. Okay.
Mhm.
So there's never any, you can look at a piece of real estate and say, oh, wow, the rents are X and, expenses are this. So here's the net operating income divided by what I bought it for. If it's debt free, that's your cap rate, you know. But if the tenants don't pay rent, the cash flow goes down, right? Or if the tenant goes bankrupt, the cash flow goes down. Or if you can raise rents, the cash flow could potentially go up. And so there's never a promised return, Amir, and we always walk our investors through this. There's potential return. It's real estate, DSTs, real estate, 721 UPREITs. There's no guarantees for any return. It could go to zero. You could lose all your money. That's why there's a prospectus, a private placement that walks you through the risk factors, and we encourage you to read it. That's also why it's very important to look at these items that we talked about, the diligence, and understand how this real estate works, what could potentially impact it. How do we build a portfolio where you're not overly exposed to any one single tenant or one single city or one single asset class, right? What do we do to protect an investor from a doomsday, Black Friday scenario, right? There's no guarantees in real estate. And that's why we do what we do. So we can walk you through how that all works. And then also we can show you, like I said, the track record. How have these things performed for our, over 4,000 investors that have done these over the years? How do they perform? Again, there's no guarantee they're going to perform like that again, right? All property values could tank and, the economy could go to shambles and tenants could default left and right and everybody loses money. There's no guarantees in real estate. So, but we'll walk you through the past. It's something to consider. And then from there, look at strategies that we've used over the years to sidestep potential issues and problems.
That's great. I appreciate the transparency. Last question here from Joy. If you have an investment in DST versus an UPREIT upon your decease, what impact do these investments have on heirs? I think you touched on this a little bit, but maybe
Yeah.
we go into it a little more detail here for Joy.
Yeah. So, just like if you continue to own your property and did never 1031 exchanged it, your heirs would get a step up in basis upon you passing. Okay. So the capital gains taxes are eliminated forever. You do have, state inheritance taxes that your heirs will have to, consider. We don't provide tax and legal advice, so talk to your CPA and attorney, but typically it's the same thing. Um, if you exchange into the DST or you're in the UPREIT and you pass, your heirs get a full step up in basis. And we've seen that many times where, unfortunately, a number of our clients have passed, over the years because we've been doing this for so long. And we'll have a DST that goes full cycle, is what we call it, where the sponsor's selling the building, investors are getting their portion, their pro rata portion of the proceeds from the sale. And most of our clients, they like what they've done. They continue to exchange and do more DSTs with K properties. We see that over and over again. We'll always have a couple that are like, hey, I inherited this from my mom and dad. I got to step up in basis. I talked to my CPA. I don't need to do another exchange. And so they just get liquid, right? And that's because of that step up in basis. But that's in general how it works. But your situation could be a little different. So talk to your CPA and attorney before making any decisions.
Okay, well, we'll end it on that note. And thank you so much, Dwight, for talking to our group. It's always such a pleasure to have you as the speaker.
Yeah,
I look forward to
absolutely.
seeing you on K Investor
Yeah,
Day, and
that'll be so
hopefully
fun.
I'll see some of the people here on the webinar today there too. I'd love to meet you all in person.
That's right.
That doesn't get to happen too often for us. So we're
Totally.
always so digital, but I'm really glad you're doing something in person and that you came and
Yeah,
spoke to the group today.
absolutely. Well, thanks so much, Alexandra. Thanks everybody. Really appreciate taking the time to dig in with me. And
All
again,
right.
go to our website, kpi1031.com. If you want a copy of the book, we'll be happy to send it to you.
Wonderful. All right, guys. Have
All
a great
right.
day. Take
Thank
care.
you. Bye-bye.
Bye.